Hello, is this Nitya Gabarhai? This is Miss Lily from Inland Revenue Board.
Yes, Lilo is speaking.
I'm calling regarding your company income tax records show that some supporting documents are missing.
Oh, I see. I wasn't aware. May I know which document are missing?
For now, we need your audited financial statements, purchase invoice, and payroll records for the year 2025. These documents are incomplete. We will need to conduct a tax audit on your company. Thank you. We'll be sending an official letter about the visit. Also, please respond within the 14 days. Okay.
Alright, I will inform my employer and prepare the document as soon as possible. Thank you.
Yeah, coming.
Ma'am, I just got a call from LHDN.
LHDN, what did they want?
They said that our company tax document is incomplete.
Incomplete? I thought we submitted everything already.
Yeah, that's what I thought too. But the officer said that because of the missing document, we are selected to tax audit.
That's audit. That's audit.
그대는 선물입니다. 하늘이 내려준 홀로선 세상 속에 그댈 지켜줄게요.
Let's discover what is tax audit together.
What is a tax audit? Tax audit is an examination of a taxpayer business records and financial affairs to ascertain that the right amount of income should be declared and the right amount of tax should be calculated and paid are in accordance with tax laws and regulations. There are two types of audit, which are tax audit and field audit. The first one, tax audit. Tax audit is held at Inland Revenue Board Malaysia office. It concerns with a straightforward issues or tax adjustment which are easily dealt with. Taxpayer may be called for an interview if further information is required. This type of audit involves checking all information on income, expenses, and types of claims made by the taxpayer. The second one is a field audit. Field audit held at a taxpayer premises involves the examination of the taxpayer business records, but in the case of sole proprietorship and partnership, if business records incomplete, it may involve the examination of a non-business record such as personal bank statement, and taxpayer will be given 14 days notice prior to a field audit. There are three types of field audit. The first one, we have the general compliance audit. This is done to make sure that the taxpayer follows all tax rules. Second one, there is the issue-based audit. This audit focuses on specific issues such as expenses claim, capital allowance, withholding tax, incentive, and technical problems. Lastly, we have a special audit. This type of audit covers more complex areas like transfer pricing, electronic trading, and audit involving international clients.
Move on to the next part, which is the objectives of tax audit. Firstly, tax audit is to encourage taxpayer to comply voluntarily with tax laws and regulation. This meaning that it is to confirm that whether the selected company have followed all the rules and laws. Next, tax audit is to ensure that a higher tax compliance rate is achieved under self-assessment and system. In short, is SAS. Thirdly, is tax audit plays a crucial role to ensure an accurate tax reporting. This is to prevent underreporting or misstatement of taxable income. Lastly, it is to educate and create awareness to taxpayers towards their rights and responsibilities under the provisions of the Income Tax Act. Audits can provide guidance on proper tax practices and reduce future non-compliance. Next is the 6 audit processes that IRBM and taxpayer will face, which is the process start with the audit revenue, second is audit commencement, third is the visit, fourth is record examination, follows with audit frame time, and lastly with the settlement of audit. Move on to the first processes, which is audit venue. A general audit is carried out at IRB office, whereas a comprehensive review is carried out at taxpayer business premise. If the taxpayer's business premise is not suitable, the taxpayer may suggest a suitable alternative for IRBM's agreement. Move on to the second processes, which is audit commencement. The audit begins through this process where the selected taxpayer will be notified and receive a request letter, which is request for documents and information letter from IRB via official email, fax, or mail. The selected taxpayer must respond within 14 days. If the taxpayer fails to do so, an appropriate method will be applied against the taxpayer. In the general audit, this letter will not be issued. Instead, the taxpayer will be notified of any tax and any adjustment through a notice of assessment. Whereby, in a case of comprehensive audit, a letter of visit, which is compliance visit notification letter, will be issued to the taxpayer at least 14 days before the date of the visit. And if the taxpayer encountered any reasonable and unavoidable circumstances, they may request to postpone the audit visit. The taxpayer will receive letter of notification where it usually highlights on important information regarding the audit. Firstly is the name of the audit officers who will conduct the audit. Secondly is intended date of visit. Next is documents that auditor required for audit and the years of assessment to be audited and expected time frame, and lastly year of assessment to be audited. Next, move on to the third processes, which is the visit. This is where the auditor starts with an interview to enable audit officers, meets with the taxpayer and obtain their details such as an overview of the taxpayer business activity and to discuss the audit. And the taxpayer required to explain about the business activities and financing. For example, details about their accounting and record keeping system. And throughout the audit processes, the person responsible for the handling of taxpayers' business record will also be interviewed, and they must cooperate for the audit to go smoothly and expeditious.
Step 4 is examination of records. At this stage, the audit officer is allowed to examine all business records and even inspect stock and equipment physically to verify claims. They will focus on records relevant to their specific years of assessment being audited. In certain cases, especially for sole proprietorship or partnership, the auditor may examine records other than business record, such as personal bank statements or property purchases. If the audit cannot be properly conducted on site, the documents may be taken back to the IRBM office, but only with the taxpayer's consent. For electronic records, the taxpayer must provide hard copies or assist in copying the data. This step is crucial to ensure that income and tax have been accurately reported in compliance with tax laws. Now, let's take a look at what counts as record during a tax audit. Records include several categories. First, we have books of accounts, which are used to record receipts, payment, income, and expenditure. These are the foundation for financial reporting. Second, invoices, voucher, and receipt. These documents are vital to verify the entries recorded in the books of account. Third, documents or material kept electronically. This includes file, database, and any other digital records maintained in electronic form. And lastly, any other record as specified by the Director General of Inland Revenue, depending on the audit needs. These records allow the audit officer to verify business transactions and ensure tax compliance accurately. For the next step, the audit time frame. Typically, a tax audit takes about 1 to 3 days to complete the examination of records at the business premises. However, this can be extended depending on several factors, such as the size and complexity of the business operation, the form in which the records are kept, whether they are digital or physical, and importantly, the level of cooperation from the taxpayer. It's also important to note that this timeline applies specifically to file audit, which are conducted at the business location. Timely cooperation from the taxpayer can help keep this process smooth and short. Once the examination is complete, the audit officer will first prepare an audit findings report, which must be approved by the branch auditor manager. Then the taxpayer may be called to the IRBM office to discuss any proposed tax adjustment. These audit findings will include the audit issue raised, the reason and rationale behind them, and the amount of proposed tax adjustment, along with the relevant years of assessment. After that, a formal notice of the proposed adjustment will be issued. The taxpayer has 18 days to file an objection along with the supporting evidence. If no objection is received within that period, or if the objection has no merit, IRBM will proceed to issue either a notice of additional assessment with the applicable penalties or a notification of non-chargeability if no further tax is due. Lastly, the audit must be finalized within 90 calendar days from the commencement date. The same issue won't be audited again, but if new information comes up or a new issue is found, IRBM can do another audit for that year.
In general, tax audits are not carried out randomly. There are specific reasons or triggers that can increase the likelihood of a company being selected. This can be grouped into 6 main categories. The first factor is the locations. Companies that are located in a major city such as Kuala Lumpur, Johor Bahru, or Penang are more likely to be selected for tax audit. This is because this city tends to have more business activities, higher income levels, and greater economy's complexity. The second factor is specific industry. Some industries are considered more complex or more prone to aggressive tax planning. For example, industries are like property development, constructions, and information technology involve large transactions. Due to this complexity, these industries are often selected for closer examinations. Methods. This refers to any hotly debated or unclear tax issue that are currently being discussed either in a court, in a tax rulings, or among professionals. Next is the third-party informations. This refers to information received by the IRB from sources other than the taxpayer. If this third-party information doesn't match the data submitted by the taxpayer, the IRB may embark on a tax audit to investigate further. Number 5 is a risk analysis. The IRB uses sophisticated tools and data analytical to identify irregularities. They compare taxpayers' financial data against industry average and benchmarks. This method allows the IRB to prioritize cases that show signs of potential underreporting or misreporting. And lastly is the taxpayer's previous record of returns. Another important factor is the taxpayer's history. Those who have a habit of submitting their tax returns late or worse, not submitting them at all, may be selected for audit more frequently. Firstly, an audit officer must always be professional, well-mannered, trustworthy, honest, and act with integrity. These characteristics are extremely important because they reflect the credibility of the officer and the department as a whole. Secondly, the officer must always be prepared to provide clear and accurate explanations about the objective of the tax audit. Taxpayers have the right to understand why they are being audited and what is expected from them, so proper communication is a key. Thirdly, an audit officer must be knowledgeable and fair in administering tax law. This means applying the law consistently and without bias to ensure that all taxpayers are treated equally and justly. Moving on to the don'ts. Firstly, an auditor must never have any personal or financial interest in the business or company being audited. Such interest would create a conflict and raise doubt about the fairness of the audit process. Secondly, audit officers should not recommend or suggest to the taxpayer that a certain agent must be appointed for the audit case. Doing so may be seen as favoritism or ethical behavior and could undermine the credibility of the audit. Lastly, the officer must never abuse their positions while performing their duties. As stated under Section 118 of the Income Tax Act, 19A, any abuse of power or misconduct is a serious offence and can lead to disciplinary or even legal actions. Let's move on to something just as important, which is the rights and responsibility of taxpayer during the tax audit. This begins with the do's. First, always be cooperative, respectful, and honest when dealing with the audit officer. Second, provide reasonable facilities and assistance to enable the audit officer to carry out their duties effectively. Lastly, make sure to respond completely and accurately to all queries. Don't withhold information. Transparency can help resolve the audit smoothly and quickly. Now, here are the don'ts. Never ever, under any circumstances, offer gift to the audit officer. Similarly, do not make any form of payment to them directly. All payment, if applicable, should be made through proper IRB channels. And finally, do not obstruct or hinder the audit officer during the audit process. Now, here are the don'ts. Never ever, under any circumstances, offer gift to the audit officer. Similarly, do not make any form of payment. Let's look at the rights and the responsibilities of a tax agent. Let's start with the do's. Firstly, tax agents must always act professionally and be fully conversant with the current tax law, regulations, and practice. This is important to ensure that they can provide accurate and reliable advice to their clients. Second, they should be honest, trustworthy, and transparent. Full cooperation with the both taxpayer and the IRB is essential, as they act as a bridge between the two parties. Thirdly, another crucial responsibility is to refrain the misusing any information that acquired during the audit process. And here are the don'ts for the tax agents. Firstly, tax agents should never give false or misleading advice to taxpayer or assist them in evading tax responsibility. Secondly, they should also avoid delaying the audit process, acting irresponsibly. Any form of delay can create tension between the taxpayer and IRB. Lastly, just like taxpayer, tax agent must not offer gift to the audit officer.
Understatement of tax. An understatement of tax happens when a taxpayer reports less income or claims more deductions than they should. According to Section 113, Subsection 2 of the Income Tax Act, penalties can go up to 100%. However, under the 2022 Tax Audit Framework, the penalty for the first offence is 50% and the second offence is 30% of penalties. Voluntary disclosure allows taxpayers to correct or declare income before the audit starts. To comply with the 2025 audit framework, taxpayers must submit tax return forms, audited financial, tax incentive info, original and amended computations, supporting ledgers and documents, and other relevant info. Missing or incomplete documents can lead to rejection or a tax audit. The penalties after the due date would be 50%. For additional disclosure, which is within 6 months of return, after amendment would be 10% of penalties. Under Section 77B, an extra 10% increases will apply. Next, provision of reasonable facilities and assistance. From Section 80 of the ITA 1967, it says that taxpayers must assist auditors by providing reasonable facilities during the investigation or audit. So, for the consequences of non-compliance, which is if a taxpayer doesn't comply, a fine between 1,000 ringgit and 10,000 ringgit will be imposed, and up to 1 year imprisonment. And it can be both. And this information is supported by Public Ruling Number 7/2000. And the last slide is about keeping the records. Under Section 82, businesses must keep proper records for at least 7 years. Failure to keep records may lead to first, income estimation by Director General of Inland Revenue, second, fines up to 10,000 ringgit or imprisonment up to 12 months, and can be both too. In summary, proper compliance, accurate reporting, and timely disclosures are essential to avoid heavy penalties or legal consequences.